Hi everyone, Todd Rosenbluth, Head of Research here at VettaFi. Excited to be part of this next ETF360 with Matt Cole of Strive Asset Management. Matt, thanks for joining me.
Thanks, Todd. Thanks for having me.
Well, it's my pleasure. So excited to be able to talk about actively managed fixed income ETFs. This has certainly been a year where active has made sense. Why don't you tell us what's going on in the space?
Yeah. So at a very high level, I have strong conviction that when it comes to fixed income, active makes sense for most investors. And there's several structural reasons regarding regulations that put the advantage in the hands of an active bond portfolio manager that knows what they're doing. But why fixed income? Why ETFs? Well, just at a high level, fixed income yields are up higher, and we're speaking today at a day where bond prices are down, yields are up. But if you zoom out, that's actually good news that there is yield in fixed income now, because for the last 15 years, there has not been yield. And right now you have treasury yields across the curve around 5%. And if you go into total return bond space like STXT, the Strive Total Return Bond Fund, you actually can get a higher yield. Most yields in total return bond funds, including Strives, are over 6%. And so that is a pretty attractive yield for most investors. And when it comes to ETFs versus mutual funds, fixed income is very similar to the equity space, where today there's several advantages by choosing an ETF rather than a mutual fund. And one of them is the ability to access daily liquidity, intraday liquidity. And a second big one that personally I find very helpful is to be able to see the holdings of what you own on a daily basis. And many mutual funds don't offer that. Some offer holdings data as little as quarterly, and I don't think that's needed today. We have more data, and investors should have that data in their hands daily to make the best decisions possible for their portfolio.
So, Matt, you mentioned about the ability to look inside the portfolio. So, let's understand within fixed income, there's levers like credit quality or duration. Where do you think the best opportunities are in this environment?
Yeah. So as a fixed income portfolio manager, there are four primary levers that I can pull. And the first one, and I'm going to go through them, talk about my views of each one of them. The first one's duration risk or interest rate risk. And as you know, interest rates have been extremely volatile. And I see the 10-year likely moving into a range of somewhere around 3% to 5.5% over the next market cycle. As we're recording this, the 10-year Treasury is currently about 4.75, so starting to work towards the higher end of the range that I see developing, but not at the high end. And so with extremely high volatility around interest rates and something in between the range that I see developing, I don't view duration risk as an extremely attractive risk to take in a total return bond fund. The second risk that you could take is credit risk, so the default risk that you're taking. And if you look at credit risk historically, where it is right now versus where it has been over the last 10 to 15 years, it's somewhere in the middle of the range, with the IG credit yield of the Bloomberg Ag right around 116 basis points. So you're getting paid to take credit risk, but you're not being paid a ton. And my view is that we're closer to the end of a market cycle, a business cycle, than the beginning, and see a recession likely coming in the next couple of years, whether it's in the next quarter or it's in the next 18 months, 24 months. I don't know. I don't think most people know, but we're closer to the end of a business cycle than the beginning, and credit risk is somewhere in the middle of the range. That's not a very attractive risk to take for me. So when it comes to credit risk, we do have credit risk in our total return bond fund, but it's right around equivalent to the ag, although we're taking some different types of credit risk, but we're not taking an outsized bet when it comes to credit risk. The third risk that you could take is liquidity risk. We talked about many of the advantages of an ETF, and one of the big advantages of an ETF is being able to take liquidity on demand. So in an ETF, that's not the most attractive place to take liquidity risk. So we would typically not be taking a whole lot of liquidity risk in our Strive Total Return Bond Fund. So that leaves us to our fourth risk, the risk that I see as the most attractive risk in fixed income funds right now, and that is convexity risk. And specifically, we see negative convexity as an extremely attractive place to take risk in a fixed income portfolio. And what we specifically see and where we take that is in agency mortgages. So mortgages that are backed by Fannie Mae, Freddie Mac, Ginnie Mae, with either the implicit or explicit support of the US government. The credit risk of an agency mortgage is near zero. But with negative convexity risk, you're actually able to pick up a spread currently of over 150 basis points over treasuries. So a higher spread pickup, a higher yield pickup in taking negative convexity risk with almost zero credit risk than taking IG credit risk right now. We see that as extremely attractive. And why is that? It's because bond volatility right now is extremely high. And that's typically measured by the MOVE index. It's at the highest levels, or just about at the highest levels, at any time other than the great financial crisis. And so the risk in the trade that we're taking is effectively that the homeowner refinances their mortgage. Well, as interest rates are shooting up, mortgage rates are shooting up, there's not a lot of refinances going on. And as long as our view of the range that we see developing in the 10-year of, call it 3 to 5.5% holds, so the 10-year doesn't go significantly below 3%, we see the refinances of the agency mortgages remaining very low, which means that we will actually be able to earn that spread pickup while taking very little credit risk in our fund.
Well, thanks, Matt. Thanks for talking about STXT from Strive. It's great to learn more about the strategy.
Thanks, Todd. It's great being here.
Thanks a lot, and have a great day.